Rip. Palantir, the driver behind the massive rally to the upside, wasn't just corporate demand, but a massive government footprint. Palantir's U.S. government revenue surged 90% year over year to reach $809 million for the quarter. So we got the government spending a lot of money with Palantir from 124 to 159, right? Looking at this chart, man, I like to see whether or not we can hold above that 159 area, that 160 area. If Palantir can do that, you get a lot of upside to the 200s, man. Surged with 28 to 30% after quarter two revenue hit up to 1.4994 billion. Their quarter two revenue was up 93% from last year. I don't really have much to say about Palantir stock, man. I just wanted to touch on the earnings and the result of Palantir stock, and it's kind of a controversial stock. But you got anything you want to say?
Oh no. No, damn Palantir, man. You know what they be on.
So bad.
Nonsense. Let's look up Lime real quick. Was we getting in different sectors?
No, we all good.
Lime, man. Lime IPO'd last month in July. On July 1st, they IPO'd. Opened up at $27. I think it was $25, man. They had a small dip pullback. They just had their earnings though, and price is now $35.70. They just had their earnings. Their earnings were up 500%. Surprise! Their estimate was 0.7. These are billions, right?
I don't really read that actually, so I wouldn't even been able to tell you. You know what I'm saying? I kind of just read. I read that on Yahoo Finances usually.
I feel it.
So I don't really read that on TradingView, but you can clearly see here that they reported 304. This might be billions. The M might be billions, or it might be million. 304 million. Sorry, reported 304 million when the estimate was 282 million. Right, so they definitely had a good surprise and beat the earnings for sure. You got whatever you got to say about?
Yeah, no, I just wanted to shed light on it, man. They just IPO'd last month, and yeah, man, they hit the high of $36. We use Lime. I use Lime pretty often, so definitely something to look at, man. I'm kind of excited to see what they're gonna bring to the table when it comes to innovation. Might be seeing a Lime rental car or something. Might be some fire.
Yes, sir. Lime, man. So, right here I got some data about the recession data. We talked about it a little bit last week. And I wanted to just kind of get the exact data to go along with it. When last week I mentioned that there's a 50% chance of a recession going into 2027. We got the data to talk about it. So 50% to 56% chance of a U.S. recession by mid-2027 was forecasted by analysts at Barclays. This estimate reflects concerns over a slowing job market and decelerating economic growth, right? So the key factors behind recession projections, right? So first, one of the factors is the labor market slowing down. Job growth is cooling down compared to the previous years. So far with the numbers that they've been giving us, I don't remember what the exact last jobs report was, but I think, the last one I do remember was from May. So from May, we ended up having like 172,000 jobs added to our economy. And then I believe when we got to the month of June, we only had about 50,000 something added. And I could be wrong. You guys do that research. But I know what we had added in May was less than June. And I don't know what we had added in July. So we'll see how that goes. But they have the labor market slowing down. You got anything you want to say?
No, spot on.
All right, bet. Decelerating growth is the second one, man. Overall, U.S. economic output is pacing more slowly. You want to break down what that means for us, man?
Decelerating growth overall?
Yeah, or just, break whatever it is.
Overall, U.S. economic output is pacing more slowly. Would that be like... Well, it says decelerating growth, right? So that says enough for itself. But I'm trying to figure out what that impacts necessarily, because the economic output I don't really know what that means.
Yeah, no, if I could guess, what it meant off rip, man, economic output, man. You know, I could do a whole lot of jumbo with the words, but I don't even care. I ain't about to do all the jumbo with the words. We about to get down to the nitty gritty.
The U.S. economic output is indeed experiencing a broader slowdown, primarily driven by weakening consumer spending, cooling labor markets dynamics, and the lingering restrictive impacts of higher interest rates. Okay, it's making sense. Now, weakening consumer spending, shit's getting high. It's expensive. Like, you can't go out and the common person isn't going to go get things that they don't need necessarily. Like, I don't know too many people going to go get a DJI drone.
No, yeah. You know, like right now, if you are, you know, it's kind of like if you are doing some excess consumer spending, it's really not the time to be doing a whole bunch of that. You know, you got to really do it strategically. And if you are carelessly, it's not no flex no more.
No cap.
So, you know, economic output is kind of what we thought, but we just didn't want to jumbo the words. Just the amount of money that's flowing in the economy.
Yeah.
You know what I'm saying? And we see a lot less than that. A lot less of that. High prices and elevated borrowing costs have squeezed household budgets, forcing pulled back discretionary spending. Literally, what we just talked about. You know, that discretionary spending is that excess spending. High interest rates set by the Federal Reserve had deliberately cooled capital investments, housing market activity, and corporate borrowing. You know, you see less people, you know, borrowing money. You see less people going to get loans from the banks. You see less people buying houses right now. It ain't the time to be making no moves, man. And slower job creation. You know, that's a big one. You know, jobs are being created slower. You know, you might have, you know, people still be able to get jobs and jobs are still out there, but they're being created a little slower. There's not really much opportunity flowing from this AI race when it comes down to job opportunity. It's more so taken from that, you know, It's opportunity in a whole bunch of other ways as far as self. But when it comes down to the job, I mean, you getting squeezed out. You know, there's so much time left. You know, even with us, you know, we work jobs, we're in the workforce, but we know we got to show up every Wednesday for what we're building because we got to build what we're building. You guys got to show up for yourselves, man. Anything to add?
Yeah, touching on that, Walmart is a perfect example. Walmart is I don't know if they're a high market cap company. They're not a $1 trillion company, but they're a high market cap company. It's kind of hard to go to Walmart and go cop a TV. You know what I'm saying? On top of that, remember that thing that they had going on? What was that, like earlier this year sometime when they laid off a lot of people?
Yeah.
And started the self checkout for the machines and stuff, and hired that happened out here where we at. So definitely impacting. Walmart's massive. There's a Walmart in every city.
Yeah. Yeah, seeing it in real time. You know, Walmart don't even want to employ people. They want to hire robots, man.
Yeah.
So that's what they got going on. Diminishing stimulus and spending. Some economists like David Rosenberg warned that fading fiscal stimulus and potential peak in artificial intelligence capital spending could create business investment vacuum by 2027.
I think it's valid.
Yeah.
I think that's valid. There's a lot of kind of with the way that AI is now, with the right tools, you can become the producer. You don't really need to go through a third party. You can become the producer for these small local businesses. So it's kind of like anybody can do it, ultimately, is what I was saying.
What would be a business investment vacuum? You know what that is, offer?
Like software, like engineering. For that example, we could create a whole app. Now, if artificial capital spending could create a business investment vacuum, it's like sucking people out. The massive surge in artificial intelligence capital expenditures threatens to trigger a broader business investment vacuum through a classic macroeconomic mechanism known as the capital crowding out. As tech giants aggressively funnel cash into AI infrastructure, they are actively drawing scarce financial and physical resources away from non-tech industries. Not what I was talking about. Not even close.
Okay, that makes a little bit more sense now. If a business vacuum is what you know what I'm saying, business investment vacuum, you're spending so much on all the resources as a whole that it takes away from the resources from the people who aren't even in your sector or industry. Um, Business investment vacuum. I want to confirm on that for sure. You want to read any of this that's here? The mechanics of the 2027 investment vacuum. $1 trillion capital drain. Wall Street estimates that annual AI capital spending will soar past 1 to 1.2 trillion by 2027. This massive concentration of capital creates a vacuum of standard corporate projects. Okay, this makes a lot more sense. Displacement of traditional capex. Non-tech sectors like manufacturing, consumer goods, and trade and traditional retail are struggling to secure funding. Boards are delaying necessary factory upgrades and standard IT maintenance to evaluate if AI should reshape their business. Okay. You got anything to say about that? It seemed like you did. I was just making sure. Debt market strain. Historically, tech hyperscalers funded expansion using internal free cash flow. By 2027, they are projected to fund more than a third of their AI investments through debt, issuing hundreds of billions in corporate bonds and aggressively driving up borrowing costs for lower rated non-tech companies. That makes a lot of sense. So we saw Google, Amazon, even Microsoft, all these companies that just reported. SpaceX and Google are the ones I could say off rip, even though they're reporting good numbers. AI capex, Meta, they're reporting good AI capex, right? That means the capital expenditures. How much money are they investing into AI to get a return back? And how much are they investing and how long is the return going to take? You know what I'm saying? I think I saw something like Google is using like 100% of their cash flow. I think there was another company that's just using at this point like all their cash flow, which is a blessing and a curse because these companies are trying to prepare for the future and make sure that they're able to stay ahead. But at the same time, we need to see that return, and then they're blowing their cash flow so they can stay ahead. But then at some point, they're gonna have to dig into the debt, which is they'll be able to. You know what I'm saying? They'll be able to pay that debt back. But it's just crazy to see how much money is being spent into this AI. I never thought about a business investment vacuum. So much money being spent on these resources that the resources for other sectors and other companies in different industries, they're not even available anymore, man. Become scarce. Interesting, man. Interesting. So
I'm gonna read this last one here.
Yeah.
AI projects are consuming the majority of specialized construction labor, copper, physical real estate, and electrical grid capacity. This leaves traditional industries facing longer lead times and heavily inflated resource prices. Now, I read this and I seen copper. This tells you right here, supply chain and asset choke points. If these AI projects are consuming the majority of specialized construction labor, copper, and physical real estate, it puts the price, just like it said, it inflated resource prices. So copper $6. In the near future, based off of this, it's telling you right now that copper and physical real estate is going to cost a lot more. Yeah. In the future, they're going to be buying up all of this, especially this part right here. They are projected to fund more than a third of their AI investments through debt. So they're buying investments with debt, through debt. They're not paying those back because the money that they go to an $800 company, just like you said, $800 company, and they're buying their debt at whether say $500, and they go to that $800. They're taking out more loans. They're not paying this debt back. They're taking out more loans based off the capital gains from, not capital gains, but the gains from their investment. That is tough, man. So having a business is important because the amount of leverage that you have using debt the right way, top tier. As well as jumping back down to this point, man, copper is $6. Copper is in every wire, every piece of, not every piece, but a lot of wiring, electrical things like a charger, headphones, HDMI cords have copper in them. It's gonna get expensive.